Happy New Year! We are here on Lowcountry Money Talk. Phil Bloyd is in because we're going to find out what happened in 2021, give a review, and we're going to talk about what's next and what to expect. We're going to talk money, and I'm so glad Phil Bloyd, of course, with Revolutionary Financial Group. Nice to see you. Happy New Year.
Jessa. Happy New Year. Glad to be here, ready to go, get things started, excited.
Excited. Boy,
Yes.
and a lot has happened. There's a lot to talk about. We're going to do a little market review for 2021, talk winners, talk losers.
Right.
So give us an overview. What have we just experienced?
So, the market average, we look at the Standard & Poor's 500 index, that was at 27% for the year. Another outstanding year. Several in a row. So a lot of people think what goes up
Must come down.
Yeah, so now we're here. But if we look at last year, some of the sectors that did really well, if you look at your portfolio, you'll know, but basically the big tech sector did well. We fought against that all year because you would hear the media saying, hey, time to get out of big tech and this and that. Well, it was the number one performer.
It is interesting because you're right. I heard a lot of talk about big tech and, there was obviously varying opinions, but one of those opinions was get out. It's going down.
Sure.
And here we are.
Yeah, and now it seems like one day the Dow Industrials may be up, and then the next day the NASDAQ Technicals are up. So, here we are. So, secondly, we had semiconductors.
Yes.
So we need those chips. We've got a lot of vehicles. We've got chip shortages. So if you go to local dealerships, a lot of them are hard pressed to have new cars out.
I have noticed there's an inventory problem for sure.
Sure, yeah, and I've noticed dealerships where before they had all kinds of vehicles sitting out there and they're pretty scarce, and one of the big reasons were they were needing these chips. So you look at the companies that participated in that, NVIDIA, AMD, some of these. So number two. Then we look at number three.
Yes, what's third?
Hey, we still have to run those cars off of gas for the most part.
That's true. Yes, we do.
So we had oils, explorations, oil companies all did quite well in number three. So that's kind of how we finished up the year.
Absolutely. And there's some similarities between what we're seeing here in terms of some of these winners because, they really all sort of work together. And, we had a huge problem getting actually inventory here and up and running. So
I think we're still in that problem.
We're still having that problem, unfortunately.
Still over 100 ships or so off the coast of California. So still having this supply issue. But let's take a look at losers because, hey, maybe they'll be our new winners this year.
Hey, you just never know.
Okay.
Let's talk about them.
So the number one losers, we're looking at precious metals. We're looking at golds, the miners. You got to get that out of the ground. So they didn't do too great.
Why do you think that is while we're on that topic?
Well, I think if we look at gold prices and things of that nature, the cryptocurrency has kind of taken some of the people that would be investing into those type of stocks away from the industry.
Yes.
So they've gone to the crypto. So that's one thing. But I've seen where BlackRock and some other analysts have come out and said they expect that sector to do quite well this year. So
it's so interesting, what can just, like you said, what goes up must come down. What goes down eventually might go up.
Sure. The other thing was Chinese stocks. Alibaba was one. That thing just took a plunge, but there's this problem with valuations of Chinese stocks. So number two there, and then solar companies didn't do too well.
And that one actually surprised me a little bit, but let's talk through that one a little. How come?
It happened before. So like in 2008 and 9, we had Solyndra and some of these, and the government was really subsidizing those, and we're like, hey, we need to be in those solar companies, and they just didn't do well.
They just didn't.
So a lot of the solar panels are made overseas in China and this and that. So that sector really did not do well.
Yeah, so some other things, again, sort of working together here, and in this case against each other for some of those losers. We do have more to talk about, of course. We're going to talk a little bit about what to expect in 2022 and sort of what's happening with stock pickers. We got lots of show left to do that and lots more to talk about. We're talking to Phil Bloyd with Revolutionary Financial Group on Lowcountry Money Talk. Stick with us. Welcome welcome back in. If you're just tuning in, I'm sure you recognize our friend Phil Bloyd. He's with Revolutionary Financial Group. This is Lowcountry Money Talk. We've had a big year to talk about, boy, and we somehow managed to recap it in just a few minutes. And lots happening, but thanks to your expertise, you kind of boiled it down for us. And boy, a lot to talk about too, and what's coming, what's sort of happening, and then what to expect for 2022. So thanks for being here.
I'm glad to be here. We got to get it going. It's going to be a very interesting year. And sometimes you don't want your investment person to say it's going to be interesting.
I'm not sure. Yeah, it depends. Do we want interesting or not? But one of the things we're going to spend some time on in this segment, because it's important. If people are investing their personal money in really trying to, do the right thing for their stocks, and stock pickers are struggling right now to beat the market. So what say you?
Yeah, so I always talk about this. Fund managers, normally have a very difficult time. So if I have a growth fund, usually they don't beat just the Standard & Poor's 500 index. So if we look at the numbers for last year, so I keep saying last year because I think it's important to see what happened last year so we can plan properly for this year.
Yes.
If that makes sense.
Well, it does, because you got to take a look at history, see what went well, see where maybe we made some missteps so that we can, plan for the future.
Let me ask you a question, Jessa. If you were down here at Hilton Head International Airport, and you were going to get on a jet and it was going to Charlotte, North Carolina, and you went in and spoke to the pilot and said, hey, what's our chances of making Charlotte? And the pilot said, well, we've got about a 15% chance of making it. How are you going to feel about that?
Pretty uncertain and not really excited about getting on that flight, quite frankly.
I'm leaving.
Right.
Open the door. So if we look at how our fund managers did, okay, so 85% of the managed funds on Wall Street could not beat the Standard & Poor's index unmanaged.
That is an astonishing percentage.
So they only had a 15% that did better. So that's that, you want to get on that plane.
That's where I'm asking for a refund.
I
don't think that's possible in either industry. But
well, though, even to add insult to that, you're paying for professional management. So these funds, they may be charging you internally 1%, 1.5%, all that. Where if I bought into that index and avoided that fund fee, I can get that index very cheaply, much less than that. So, and at least I'm going to do the average. So when you're paying for management of assets, the idea is to outperform
the market.
Yeah,
absolutely. And are people aware of that's happening? Do they check in and say, hey, where did we perform?
Well, Jessa, the market's done so great over the last several years that when I talk to people, I may be out in an event or something, I'm like, how's your money doing, Jessa? And you're like, oh, it's doing great. And I'm like, well, it should be. Because we've been in the longest bull run, one of the longest bull runs in history. So if you aren't doing great on your growth assets during this market, you really got a problem.
Right.
But where they're missing out is they're not doing that comparison. So by the time you told me, hey, I'm doing great and all this, so I'm going to water it down a bit and say, compared to what?
Compared to what? That's an interesting point, because doing well isn't necessarily an indicator right now that your portfolio manager is really doing their job.
So a lot of times people will just tell me, Jessa, they're like, well, I'm up, I'm way up. And I'm like, okay, what's way up? And they're like, well, I'm up 20% this year. And I'm like, okay, the index is 27. And they're like, oh. So I'm like, you're below average.
Right.
So once we start comparing that, and then we start looking at the fees, like I mentioned, the fund managers and all that stuff, and we start comparing the fees and the expenses and all this, and I'm like, wow, this is what you're paying, and this is what you're getting in return. So if I'm below market or just average, I'm like, well, I could be paying quite a bit just to get average.
And the opportunity cost of where you could have been, on the upside of that 27% if you had the right manager. So that's a very good point to make, and you're right. There's so many people who are so happy with where they landed at the end of the year, and yet 85% of them really could have done at least average or better.
Right.
So interesting point. Well, wow, that flew by. Fun topic. We got more. We're going to talk some more money. It's Lowcountry Money Talk. Stick with us. And you're back with us here on Lowcountry Money Talk. I'm Jessa Jeremiah, and Phil Bloyd is still with us, of course, because we have lots more to talk about. He's with Revolutionary Financial Group. And boy, making some really good points about 2021. Sure. Thank you for joining us. We have another half a show to go.
I enjoy it. Boy, it's going so fast.
It is. You know what? This is fascinating, though, and I'm guessing our viewers are finding it so, too, because we had such an interesting year. A lot of people feeling really good about how the last year and plus has gone. Mm-hmm. And there's still a lot of uncertainty about what's to come. Yeah. And so we're really going to talk a little bit about that. Not only uncertainty, personally, but even predictors are really, we're seeing varied conversations.
Big varies, big difference, big swings. Yeah. One thing I'll point out, just to keep things up to date, I looked at the Wall Street Journal this morning. Before the jobs number was released. The jobs number was released this morning at 8:30, and I was reading topics. It said, stock futures tick up as they expect big job numbers. The president's already scheduled a press conference, so obviously he's expecting big numbers. So Wall Street was expecting about 400,000 new jobs created, and what do you think we got?
Well, based on the way you're talking to me, I'm going to say not 400,000.
Less than half. So we got 199,000. The market started ticking down. Those futures erased right away. So my point in that, Jessa, is that these experts in Wall Street and finance, they're still getting things wrong as far as the predictions. Now, the unemployment rate ticked down to 3.9, but our labor participation is only 61%. Right. So there's 39% of the people out there that should be working that aren't. So once they start removing those people off the unemployment rolls, the unemployment number goes down, but it's very deceiving.
Mm-hmm. This brings up a question that I have, which is how typical is this inaccuracy? I mean, the predictions are so far off, and is that just a sign of, everything that we've gone through over the last couple of years, or is it relatively usual?
Jessa, there's been a lot of things that have been done that have never been done before. So if you look at how the Federal Reserve has played into this a lot of people believe they missed the inflation. Mm. We've been talking about that on this show. Yeah. So they talk about this term transitory. That's not a word we're really familiar with very often. And then they said, don't use that word anymore, meaning that they kind of missed the boat on it, but they're reluctant to say they were wrong. But the other thing that the Fed has done for the first time is normally when they want to stimulate, they buy into U.S. Treasuries and Treasury bonds. And this time they've actually bought into corporate bonds and corporate bond ETFs. They've never done that before. Mm-hmm. So as you're listening to the news, they're talking about raising interest rates. They've already agreed to 3 times. Many people believe it'll probably be more like 4. A lot of people are thinking maybe it's going to be 0.25% each time or 25 basis points. So if they spike it with 0.5% at one time, the market's not looking for that. So a lot of our good stock market that we've had over the last few years is because those interest rates have been really low.
Yes.
People need somewhere to invest their money to get a return.
That's the truth.
So if we look at that going away potential, and the Federal Reserve has been wrong so much with inflation and other things, they're going to have to start not only tapering how much in bonds they're buying, but they're going to have to start selling those. If they don't, then our inflation is going to skyrocket.
Right. Wow. And that's what everyone's fearful of, too. And when there is so much uncertainty, obviously we've talked before on this show about making sure your portfolio is diversified, but that could have some different implications right now based on what companies are doing well, because there's just a handful of them that are taking up a big portion of those gains.
I think, as we get into our next segment, that's a good place we should start, is saying, what sectors do we see in 2022? No one has the crystal ball, of course, but what sectors do we see that may be moving up and just make sense because of the kind of market that we're in?
Ooh, that's an excellent teaser. You'll have to stick around for that one. We're going to do that next. Thank you so much. Phil Bloyd and I are here on Lowcountry Money Talk. Stay tuned. Welcome back into Lowcountry Money Talk. We left you with a really good teaser because we're going to talk a little bit about what to do with your money in 2022, or at least maybe what some of the predictions are. Phil Bloyd's here with Revolutionary Financial Group. We've wrapped up 21 in a nice little bow, and now we're looking ahead. How are you?
Put it on the shelf.
Yeah.
It's good. I'm great. So I think, Jessa, going into 2022, you know, this time of year we have the New Year's resolutioners. So one of the big resolutions is always, hey, you know, I need to do something about my finances. I need to get my estate in order, all these things. So we will have events. All of our viewers here will probably see, or you can go to our website or whatever, but we'll be doing events the first quarter of the year. So you want to probably try to come to one of those, because I'll dig down more in depth on some of the issues.
Yeah, absolutely. And having you here, I get to see you in person, and I get to ask you questions on the break and all those fun things. But having you in person and to, you know, really understand what it is that you do at Revolutionary Financial Group to help you know, manage these portfolios, to help your clients, and all of the implications that you're understanding in terms of expenses. It's great. So that being said, you're going to kind of guide us on a tour of 2022,
right?
And what are we looking at?
So the crystal ball, not mine, but let's go with the Wall Street strategists, whoever they are. So what I saw in the Wall Street Journal is the Wall Street strategists are expecting that S&P 500 index to be up to 4.5% in next year. That's from the Wall Street Journal and the Wall Street strategists, whoever they are. Morgan Stanley, on the other hand, they're expecting that index to be negative up to 6.9%. So that's a pretty good variation. Yeah. So I think if we look at the S&P index, the first thing I want to look back to last year just a second again and say, you know, of that index, according to Wall Street Journal, 1/3 of the gains in the Standard & Poor's 500 index for last year was just 5 companies.
Oh, wow. I mean, that's kind of mind-boggling if you think about it, because we do talk about being diversified, and then here we've got this huge chunk all in these top 5. So what does that mean?
So without Microsoft, NVIDIA, Apple, Google, and Tesla, that's index wouldn't have performed as well, because that's 1/3 of the index. So how do we think those will do next year? I don't know, but it's going to weigh heavily on how that index performs. So what I would recommend is what I always recommend. I deal mainly with retirees, okay? So the idea is, you know, depending on your age, it's going to be really important this year, I think, to make sure that we have the right amount at risk, you know, just in case Wall Street strategists are right, we want to get our return. But on the other hand, in case Morgan Stanley's right, we don't want too much at risk. Now the problem could be is if your portfolio is arranged to take all of your distributions out of capital gains from your stock accounts, if those, you know, gains are going down, we probably don't want to affect those. So we need to have an alternate plan to where if the stocks aren't cooperating this year, we can take income from that. So.
Okay, got it. Well, and there's a lot to think about, and it's so hard to, like you said, just navigate when you've got the experts at such odds in terms of what to expect.
They're having some major problems. So the one thing I like to leave people with, other than, hey, now's the time, it's the beginning of the year, make sure that you have, you know, you get with your local attorney, you have your estate plans in order. Unfortunately, I lost a few clients in the last month, so that's when they really start, oh, are my estate documents in order? Well, we want to make sure they're in order before that. Look at your tax returns from last year, see if there's going to be any changes, do some strategies there. The sectors that I keep hearing about is more like banks and insurance and financials, because interest rates may be going up. Energy sectors, we're looking at possibly $4 a gallon gasoline by Memorial Day. Materials, and then commodities. Now, they thought the metals did bad last year as they did, but they're thinking they might do good this year.
Wow. Well, and there's a lot of considerations to be made. There's a lot of information in that head. It's been fun to pick your brain a little bit about, you know, just what we saw in 21, what to think about for 22, and boy, it's a nice time to just sort of regroup and make sure your ducks are in a row and your strategy's on point.
Absolutely.
So thanks for helping us out
all
today.
Right.
Again, this is Phil Bloyd, and you've been watching Lowcountry Money Talk. We are all set. We'll see you next time.